Hi, and welcome to the Me Inc. series on the law of supply and demand versus the law of value and demand. This is part one of a three-part series. So here's a little bit of an overview of what we're going to talk about here. Modern, that is to say neoclassical economists, believe in the law of supply and demand. This is mandating an upward sloping supply curve, that is to say from lower left to upper right, and a downward sloping demand curve. This in turn calls for a single point equilibrium where these two curves intersect. And neoclassical economists think that this is a ubiquitous condition, applies to virtually everything. If we can find a case in which this paradigm does not hold, the law of supply and demand no longer applies. And we're going to discover here that multidimensional economists find that most markets have more than one price point. And this turns out to be hugely important. So we've had a long and storied history of the law of supply and demand, spoken about here by Dr. Paul Samuelson in one of his textbooks. He won the Nobel Prize in 1970. He's considered by many to be the father of modern economics. The law of supply and demand will work for elements like 24 karat gold. If you were to take yearly production of gold, as shown here on this chart, and then wed that to the prices for gold, you could come up with a curve that looks like this for a 5-year stretch from 2008 to 2012, in which you see an upward sloping supply curve, again, quantity, in this case metric tons on the horizontal axis, versus price on the vertical axis, and there was an upward sloping supply curve for 5 years. But very importantly, 24 karat gold is a single feature element. We're going to need to know, how does the law of supply and demand work for products that have multiple features? So a supply and demand curve for ground beef might look like this one. This is data taken from the United States Department of Agriculture, and from 1980 to 86, the prices were in a downward trend as quantities increased over that entire period. And so the classical economists, neoclassicals, the current economists would say, look, there should be then, in 1986, an upward sloping supply curve in which that curve intersects the demand curve at a single equilibrium point, as shown here. Now, in order for this to be useful, it should predict behavior in the market. We're going to ask ourselves the question here, does it? Does it really work? Well, if you go into any U.S. supermarket, you're likely to see something like this when you get in the ground beef section. What we see here is we're just told that there was one equilibrium price, but yet we're seeing several. This by itself is a sufficient condition to invalidate the law of supply and demand. We're going to need to know what it is that explains prices, and we're going to see that in our next video. So in sum, the law of supply and demand is a long-standing idea, and it suggests that there's a single point equilibrium at the intersection of a supply curve and a demand curve for every market. But since that's what their suggestion is, if we find more than one price point in a market, it disproves that theory. So the law of supply and demand will work for a single element feature like 24 karat gold, but it doesn't work for something as simple as ground beef. We need to have another theory to explain prices for products that have more than one feature. And we'll see that next time. Thanks for watching.